All right, so here's our basic agenda. Two main things. The first is we're going to discuss the markets, kind of where we've come from and maybe where we're going. And from there, we're also going to break down the new legislation that just passed last week, fresh, hot off the press, particularly as it relates to tax updates. So let's start with kind of where we entered the year. And if you remember, if you'd like to go back and watch or read our initial commentary at the beginning of the year, our market outlook for 2025. Again, we don't do prognostications on, how much the market's going to be up or down, or I think it's a waste of time. But what we tend to do is look at what set of conditions are out there and what is relevant, and how could that impact market direction, as well as maybe what we should do with investment portfolios and money. So as we came into 2025, we started with what we saw as some unknowns, and depending on how those unknowns resolved themselves would help us determine which direction and how its effect to the market it would be. So inflation. Our view was that inflation would remain tame, and if that happened, that would have a positive impact on stocks. Financial conditions, we felt that there would be a normalized Fed policy. Okay, in other words, we had this large rate increases and then backing off of the rates, and things were all over the place. We felt that the Fed could be a little bit more consistent and measured in what they do, and then that also within those financial conditions that there would be somewhat of a pro-growth tax policy. We'll talk about that. That's somewhat being metastasized now. Mortgage rates, we saw mortgage rates starting to moderate a little bit closer to 6%. And if that happened, that would be a positive impact on stocks. That seems to be kind of where things are heading and what's happening. Investor flows, if you remember, we talked about how there was a lot of cash on the sidelines. And we'll talk about whether that's in the market yet or not. Tariffs and deportations was something that was a hot topic at the time. Obviously, they remain hot topics. Tariffs in particular have had a very very large impact on stocks. And obviously that's where back in March and April we had a lot of challenges within the market. Doge, and then corporate profits, and then sentiment, where investors were. We felt that investors were becoming at the time more bullish. If they got too bullish, that's a bad thing actually. And if things are pretty bearish, that tends to bode well for stocks. So that's where we saw coming into the year. If a couple of you have actually made reference to this chart, probably because I've shown it almost every time. But this is the S&P 500. This is where we started the year, okay? And we were in this nice bull market channel. We had kind of this upper range and a lower range. And again, we've talked about this a lot, but trends do tend to tell us a lot, at least directionally. And when you get a break in a trend, that tends to have an impact on what might happen, with future trends and such. And so this is where we were. Inflation, this is the 5-year look. Inflation as of right now, okay, this is kind of the mid-year update, remains tame. So we do think that inflation is going to be mild and tame. We don't necessarily see any huge blips. There's a lot of discussion about whether tariffs will be very inflationary. Quite frankly, that has not yet shown up in the data. Will it? Possibly. But I don't think it's probably going to be as large of an effect as people made it out to potentially be. The other thing that I'll mention about inflation is this. When I talk to individuals, what I tend to hear at times is they feel that, prices just aren't going down. And I would agree, that's correct. And let's define that inflation doesn't mean, if we get lower inflation, it does not mean that your prices are going to go down per se. It just means that the rate of increase in prices has slowed. So if you're sitting around waiting on prices to go back down to where they were, that's highly unlikely to happen unless it's in certain volatile commodities or things like that. Inflation simply just means that the pace of the growth, the paces of those increases are slowing. All right? If they were actually going down, it would be deflation. This is the long-term inflation chart. So again, we've moderated quite a bit. We feel very comfortable about where things are within the inflation side of things. Right now, that is not very high on the list of things to be concerned about, frankly. But tariffs, and so this is a big one. And so here we go into March and April. Tariffs were the headline. And we, back in March and back in April, we sent out some commentary and videos out to all of you, just with our thoughts as we were going through what was a pretty tumultuous time. And so our nice little pretty neat chart where we were up in this nice little bull market within these trend lines, you can see completely got broken. And when that happens, okay, that's when you need to take note, because obviously when we pierce through that trend line on the downside, you see from the chart there, and you remember from this, we had much more significant sell-off. At times, I get questions about, well, if that's typically what happens, if we pierce through a trend line, why don't we just sell and get out and wait things out if we think it's going to go a lot lower? Because the problem is, again, one, we are long-term investors. The reason we focus on this is to give us some semblance of an idea of expectation about, okay, all right, maybe we should brace ourselves a little bit. Okay, maybe this will take a little while. But no one is good enough to time when to get out, because you also have to time when to get back in. And as you're going to see here in a minute, there's a lot of people that are not back in, and the market whipsawed back in a V-shaped pattern, and a lot of people missed that and are still missing out on that, the ones that did try to get out and get cute. So what do you do when this trend is broken? Well, if you look here, you'll see this is our trend from 2022 on up, and then that's where it was broken. Well, what you need to do is then look longer term and see, okay, well, what longer term trends are still intact? And what's pretty remarkable about this is that if you zoom out like this chart is now showing, where we're going back to, say, 2018, all right, it's showing that in the 2020 lows, which was COVID, if you remember, and then you have some lows here in October of 2022, they actually, you see now this longer term trend is still very intact. And if you look at April of 2025, this year, and where the lows ended up occurring a couple months ago, we were right off of that same trend line. And so this actually is, in my view, a very good indicator and help to tell us that, you know what, this trend is still intact. Yes, we broke through that shorter term 2-year trend. Things got really nasty for a while, but if you look at where we bottomed, okay, we are right in line with a very long-term bullish trend pattern, and therefore the bull market is not over. That truly is the definition of a market. This long-term bull market is not over. Okay, so that's an important point I think to make. But let's talk about tariffs again, because that's obviously what roiled the market in April. So we have this very V-shaped pattern that occurred. And this is, candidly, it's probably one of the, I've heard some call it the most hated V-market recovery in history. Because even today, you hear a lot of people talking about, they think we're going to go retest the lows. The worst is still ahead of us. The market just whipsaw back. We still have a lot of downward pressure ahead of us. There's a lot of concerns, etc. Yes, you can make that case, but I'll tell you that generally speaking, that's probably the reason that this market might continue to go higher, because there still is so much pessimism out there, okay? And the market tends to run contrary to how people think. One other just little anecdote that I'll share. I remember in January of this year, right, when everyone produces their market outlook pieces and such, and I remember getting on BlackRock's their own institutional webinar and kind of listening, and I heard Larry Fink, who's the head of BlackRock, talking about his view for the year ahead, 2025, and I remember him saying, that he was bullish, that he felt good about stocks going up, and he literally said the words, I've been racking my brain trying to figure out why stocks would go down, but I can't think of anything. And you know what? I made a mental note of that because, again, you don't make market-moving changes on things like that, but that was a pretty clear indicator at that time going, you know what? We're probably a little more, peak optimism. We probably need a little bit of a correction, because if somebody like that is saying he can't see any reason why the market's going to go down, that's usually a tipping point at some point when that's the level of optimism that the public is seeing. So here we are, tariffs. Now, this is a tweet, or I guess not a tweet, it's a Truth Social post from President Trump the other day. This is literally yesterday. And the reason I'm showing this is to demonstrate how the market is behaving today versus how the market was behaving 3 months ago. So this was a Truth Social post where Trump says tariffs will, they sent out letters to all these countries saying, here's your tariff, et cetera. They're going to be implemented on August 1st. And so he says tariffs will start beginning on August 1st. There's been no change to this date. There will be no change. In other words, all money will be due and payable starting August 1st. No extensions granted. Thank you for your attention. Right? That's a pretty unequivocal, bold, hardline statement. Now, think about how the market may have reacted a few months ago, March, April timeframe, to a statement like that. Yet, okay, I want to show you how the market reacted yesterday to that statement. And so this is a chart of high yield spreads. That's a fancy way in the bond market of basically saying how much risk is being priced in. And you see back in April, March and April, when things were happening, there was a spike, okay, in this high yield spread, indicating that, okay, the bond market is seeing a lot of fear and they're pricing in a lot of risk. Well, yesterday, what happened in these same rates? Essentially no change. And so really, I think what is happening, and if you remember, I actually watched my comments both in March and April recently, just because I wanted to remind myself of what we were saying. One of the things I remember saying, as well as telling a lot of you, is, if you look at Trump's first presidency, and if you not that anyone can predict what Trump's going to do, because that's a fool's task, but the bark a lot of times is bigger than the bite. And I think the market has kind of sniffed out that, we're not going to get too alarmed over every little, tit-for-tat tariff comment, that Trump is probably doing more of, negotiating through the media and these statements to land on some type of deal. And that's essentially how the market is behaving. And that's essentially kind of what we've been seeing as this has played out. So here's our view is that, you're going to get some tariff headlines. You're probably going to have some market-moving things as you get closer to August 1st. But I do not see the level of fear and panic and market-moving meltdown that we had in March and April. I just don't necessarily see that happening regarding tariffs anymore. Now, the next question that we get asked is, okay, right now, we've had that huge sell-off, huge recovery, but man, aren't stocks overvalued? I actually, almost in every conversation I have, with people asking our view on the market or what do you think about stocks, they say, man, they've got to come down. I mean, we all know stocks are way too high. Well, are they? When I saw this, this is something that Tom Lee from Fundstrat put out the other day. And when I saw this, it's pretty remarkable. Again, data is going to tell you the story. You have to look at data. You can't operate with feeling and emotion. And so this is the S&P 500. Okay, so all 500 stocks, and it's equal weighted, meaning that every stock in that 500, all 500 of them have an equal weighting in this calculation, instead of the biggest ones, taking the cake. And if you look at the median price to earnings ratio, so that's a measure of valuation. What's the price of the stock relative to their underlying earnings? So the higher that number is, it could potentially be more overvalued. If you look at that price to earnings ratio, dating back to just before COVID, okay, the median was 17.6. And throughout the last 5 years and all that we've gone through, okay, and markets being up the way that they are, the median price to earnings ratio is 16.9. Essentially similar to the average over the period, and actually lower than just those pre-COVID levels. That's pretty amazing. And whether we think there's additional correction ahead or not, I don't think you can make a case that the market is so overvalued that we're just in the stratosphere and things have to come down 40%. I've heard that argument. The data doesn't necessarily show it. And one of the other reasons that, again, I think the market is probably not going to whipsaw back down is that if you look at this chart as to how institutional and hedge funds are positioned, okay, meaning that if they're bullishly positioned, they have money in stocks, or if they're bearishly positioned, they have money in either short positions or they're betting that the market's going to go down. The net positioning for how large institutions and hedge funds are currently is some of the most negative since March of 2024. And if you look at, that's not necessarily an indicator that markets are likely to go down, because if you look, they're positioned negatively, primarily because they've missed the rally and they're hoping that the market will go down. And a lot of times when they're positioned negatively, that's a contrarian indicator again. That it's when you need to get worried when they're overly bullishly positioned that you can run into issues. Like, for instance, look at the same chart, the end of 2021 or early 2022. Okay, when did we peak? Right around that time. They were very bullishly positioned. And all throughout 22 and 2023, they were bearishly positioned. And what did the market do in 2023? It went straight up. So again, I share these types of things to at least give you some frame of reference so that you can have an understanding about maybe where we are in the process. That doesn't necessarily mean we're heading straight up. I think it's going to be choppy. I don't think you can make the case that we're going to have these huge returns like we did the last 2 years. I think it'll be choppy, but I think it'll still be positive. So, a couple quick things, and we're going to move on to taxes. I've showed this probably almost every time, and I'm going to keep showing it because this is the state of affairs. And in April, we literally just went through probably this whole cycle, okay? But markets, they're going up. We get optimistic. We get excited, etc. In euphoria, that's usually the peak of the market, when you feel the best. And then as markets start to go down, think this recent sell-off in March and April. There's a little bit of anxiety, there's denial, then there's desperation, panic, and eventually there's capitulation where people just throw their hands up and say, I can't take it anymore. That's usually when you find bottoms and you can go up again. Well, that's great, Nick, but what about the black swan? Okay, the black swan again being that unknowable, the things that we don't know. Well, one thing I'll tell you is there's an old saying that markets climb a wall of worry. That's going to be true to the end of time. Markets will continue to climb that wall of worry. Again, if there's no fear in the market, it's a bad thing. But let's talk about that black swan. First of all, is that a reason to not be invested? Well, if you're investing in fear, you're not invested, and you're actually, you're going to make very bad investment decisions. But I think you could argue that we've probably dealt with 6 black swan events in the last 5 years anyway. Okay? You don't believe me? Well, think back. You had the COVID shutdown of 2020, black swan event. You had the supply chain crisis, okay, that kind of came out of COVID, right? Remember, stuff, you can't find stuff, supply chain, everything. Very disruptive to the market. Completely, a year prior, no one could have seen that coming. You had skyrocketing inflation in 2022. You had the fastest Federal Reserve rate hikes in history in 2022. In April of this year, we have a tariff crisis and the global fallout of what went on there. If you remember in some of those comments that I shared then, I was talking about the level of fear and the level of bearishness in the market. They were, in some cases, in some measures, exceeding that of the great financial crisis in 08-09. That was remarkable to me. And if I'd have told you, hey, in 2025, the U.S. is going to bomb Iran's nuclear facilities, you probably would have said, it's going to start World War III. We can't invest in that environment. Market's going to go down, probably 50%, because all of a sudden we're in World War III. And that happened in June of this year, and here we are. It's remarkable. So I would caution you not to get caught up in those black swan events, because your emotions could have easily kept you out of the market. All right? Last thing I'm going to hit very quickly, I threw this out, I think a year or two ago in one of the presentations. I'm going to hit it again because this stuff starts popping up, especially in March and April when you go through those types of events. You start hearing these bold predictions, okay, coming out of the woodworks. Market's going to crash 50%, et cetera, et cetera. That is nothing new. Those have been around since the dawn of time. There are people that are going to forecast doom and gloom because they want to sell something, want to sell fear, et cetera. I swear these people are financial charlatans. And one of the worst is Robert Kiyosaki. He wrote one book, got some fame, and now, literally, this every time he has predicted doom and gloom, the market's rallied. So I throw that out just to chalk up back of your mind, okay, the next time I hear something, let me not get too worried. We'll talk about it and go forward. Sir John Templeton, probably one of the greatest investors of all time, said, bull markets are born in pessimism, they grow in skepticism, they mature in optimism and die on euphoria. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. Think of just a few months ago, April, we were down, I want to say it was 18%. The level of pessimism and fear was exorbitant. I had clients calling us, some of you probably on this call. To this day, I still hear people say, I think the market's going down 30%. Those are, you have to separate the emotion from the data. And this year, buying the dip, buying those down moments and down days has been not only a winning strategy, but 2025 is, believe it or not, to be on pace to be the second best buy the dip moment in the last 40 years. Now, we don't know what's going to happen the rest of the year, but I think the biggest dip, the biggest down part is already behind us. The last thing I'm going to mention on the market, and the only reason I'm bringing this up is because to help check on your emotions. There's a lot of data that I've been reading, and it's very interesting. Your political party affiliation or your political leanings have a very a measured impact on your feelings about the market and your, in a lot of cases, investment decisions. So when there's, say, people that don't like Trump, Republican control, they're very pessimistic on the market right now. Okay, if you flip-flop that a few years ago, when President Biden was in office, the people that were very anti-Biden, very anti-Democrat, were very pessimistic about the market, and vice versa. The Democrat or they were very positive, or more positive at least, on the markets. That has been true, and it's actually the data that I'm seeing from other sources is that is even more exacerbated today. I think it's because of the polarization. Trump is a very polarizing figure. You either love him or hate him, it seems. And people have boiled that down to their investment decisions with a lot of heavy political leaning. I'm going to caution you, we can't do that. Markets, if you would have done that, you notice what you get from this slide is that you would have lost out on a lot of growth, and that remains to be true. All right, so that's markets. Again, just tried to cover that as quick as I can. Now we need to talk about this tax bill, the one big, beautiful bill. And yes, that is its official name. We've got to come up with something better because that's a lot to say, and even the acronym OBBBB, that's just tough. We got to figure out a better name. So let's go through this. I didn't plan originally when we sent out this webinar invitation to spend a ton of time on this, but this has now become law. It's in effect, and as Steve and I were really digging through this and reading it, and kudos to Steve for, you know him. He's head in it. Like this is his thing. So he's been spending a lot of time reading the bill, reading commentary about the bill, and what we're going to share today is what we know and what we don't know. And there are a lot of things that are kind of deep in this bill that you should know about. So here we go. So the one big beautiful bill, I'm just going to call it the bill, was signed into law July 4th. So when we were all popping off fireworks and things like that, they passed the bill. Trump signed it. So a couple key highlights. The first thing is that it permanently extends the lower Tax Cut and Job Act rates that originally went into effect January of 2018. Okay? So when you see TCJA, we're talking about the Tax Cut and Job Act. That was the bill passed in 2017 that went into effect 2018. There's the temporary tax deduction for seniors that we'll talk about. There is an increased state and local tax deduction cap we'll talk about. There are limits on tips overtime changes. There are some changes to energy credits. It's important to note that some of these changes that we're going to go through are effective now, retroactively 2025, and some that have taken effect 2026. And the other little wrinkle is that some of these are permanent and some things are not, and we'll talk about that. So here's probably one of the biggest takeaways that I want you to get, is that overall, okay, the bill extends a lot of the tax planning strategies that we've been doing with our clients and with you. Again, one of the things we focus on is how do we minimize your tax bill, not necessarily today, but over your lifetime. And as we forecast income and sources of income and strategies and tax changes, etc., what we're trying to do is figure out ways in which we can minimize and mitigate that tax bill. So let's talk first about those tax rates. So the Tax Cut and Job Act, when that was passed in 2017, that created essentially some of the lowest tax rate ever in the history, in the U.S. history. So on this left side, you see the marginal tax rate under the Tax Cut and Job Act. Okay, we have a 10%, 12, 22, and so forth. Now, what was scheduled to happen is that if this beautiful bill wasn't passed, all of those tax rates that were lowered starting in 2018, those were scheduled to go away, to expire, and that everything would revert back to what the tax code was prior to that passage. So this yellow column here is what they would have, what they were scheduled to revert back to. Okay, so you see a lot of those rates go back up, and some fairly substantially. The other thing that happened with the Tax Cut and Job Act is that it increased everyone's standard deduction amounts. So again, most of you know this, but you as a tax filer have the option of either keeping track of all your itemized deductions, like your mortgage interest and charitable deductions and things like that, or if you don't want to fool with that, or if it's not that much, you can just take a standard deduction. Well, the standard deduction was raised up to, in 2025, those numbers are $15,000 for a single and $30,000 for a married couple filing jointly. Well, those rates were scheduled to go back down, you see, pretty substantially. Okay, down to just over $8,000 for a single and $16,700 for married. So that's largely in half. Okay, that actually is a pretty significant tax change. Well, what has happened is because of the extension of this, that's now made permanent, and here we go. So there's no more reversion potentially back to the old tax rates. The Tax Cut and Job Act marginal rates are the marginal rates permanently. And I use permanently in air quotes because nothing's permanent. It's permanent until Congress decides to change it again. Okay? So if nothing happens, there's nothing that's going to revert back to anything. Those rates are permanent until we get some sort of legislative change again, whenever that happens. And we know it eventually will happen. All right? And then also the standard deductions you see are now made permanent. All right, so that's a good thing. So there was a little bit of fear, especially last year before we knew any kind of election results, about, these tax rates are going to bump up, and now they're permanent, and we're good to go. The other thing that came about in the one big, beautiful bill is that they're now, let's all, big golf clap, no tax on Social Security income. Except that's not really true. That's what I think was the original intention. We'll talk about probably why that didn't go that way. But when you hear the no tax on Social Security, okay, and there was actually, did anyone get that email? I did, from the Social Security Administration the day after the bill was passed. Hey, no tax on Social Security, and it was, I think they were actually forced to send out a new email that made it a little bit more clear that that's not exactly what it means. So let's explain what it means. What happens now under this new bill is that there is a temporary personal exemption for seniors. This personal exemption is the attempt to make seniors, people who are collecting Social Security, hopefully, not pay tax on their Social Security. Okay? So here's how it works. There's a temporary, and I'll explain why it's temporary in a minute. So you will receive, or a senior, age 65 and older, so you have to be 65 by the end of this tax year. A senior will receive a $6,000 bonus deduction. So it's like the standard deduction, but it's just an extra bonus. Okay? So this $6,000 goes above and beyond the standard deduction. And somebody that itemizes, okay, instead of taking the standard deduction, it also gets added on top of your itemized deductions. So you get either or. If you're standard deduction, you get the $6,000 extra. And if you itemize, you also get the $6,000 extra, which is pretty cool. All right? This is also per person. Again, 65 and older. Your age is determined by how old you are at the end of the year. By 12/31, if you turn 65, you're included. There are phase-outs. So let's explain what that means. If you're a single taxpayer, if your adjusted gross income is above $75,000, it starts phasing out. Once you get to $175,000 of adjusted gross income, that $6,000 exemption is fully phased out. You don't qualify for it. For married filing jointly, if your adjusted gross income is above $150,000, it starts phasing out. And once you get past $250,000, it's completely gone. Okay? And the reason we say it's temporary is because this $6,000 bonus deduction, as of right now, expires in 2028. Why 2028? Well, there's probably a political event that happens right around there, and I'm sure it's going to be a point of political discussion in an election. So here's kind of the intent. In lieu of a promise not to tax Social Security benefits, the bill aims to try to nearly get 88% of Social Security beneficiaries to no longer pay tax. So really, honestly, what it's doing is the people that are not benefiting from it are the people with high income who are 65 and older, because they're getting phased out. They're not getting any benefit. Their Social Security is still going to be taxable just like it was before. The people that are going to get the most benefit are the under those AGI thresholds. The lower income people are going to get the bulk of the benefit here. So technically, again, there's no change to how Social Security is currently taxed at the federal level, which again is a recap. If you're single and you have income larger than $34,000, 85% of your Social Security is taxable. And if you're married filing jointly and your income is higher than $44,000, 85% of your Social Security income is taxable. Again, that's regardless of age. That has nothing to do with the reduction in benefits. That's just the taxation. All right, so that was one of the big ones. That's one of the big question marks everybody has on how this works. Hopefully that helps clear it up a little bit. Here's a quick example. So in 2025, again, this goes into effect this year. In 2025, a standard deduction for married filing jointly. All right. So if both spouses are over 65 or 65 over, then they're going to get the standard deduction of $31,500. They're going to get a bonus additional deduction. That was already there, by the way. This is not new, that $3,200. It's essentially a higher standard deduction for older people. So they're going to get that. And then they're going to get that $6,000 per individual for $12,000. So in this case, they're going to have a standard deduction of $46,700. That's a lot of money. That's pretty remarkable. So in other words, they're not paying any tax until their income exceeds that number. All right, and a single person, same thing. They're going to end up in that scenario with $23,750 of a standard deduction. Okay, let's discuss the state and local tax deduction amounts. All right, so the SALT, if you heard the term, that stands for state and local tax deduction. So that's things like your property taxes on residential real estate, on like your home and things, any other local taxes paid, your state income taxes paid, things like that. Used to be that you could deduct essentially whatever that was as an itemized deduction. And in 2018, with the Tax Cut and Job Act, it capped the amount that you could deduct at $10,000 instead of just being deducted whatever your taxes were. That got a lot of backlash, and particularly people in high-tax states. So it provided filers who itemized deductions. Again, this has nothing to do with a standard deduction. This is only if you itemize. This is where that applies. Okay? And it really impacted the people in the high-tax states. So people like in New York, New Jersey, California, Illinois, and so forth. So the beautiful bill raises that SALT cap from $10,000 to $40,000. So in other words, somebody, when they add up all those state and local taxes, if they itemize, they can deduct up to $40,000 of those taxes. However, this is essentially for households earning under $500,000 of adjusted gross income. So an individual in one of those high tax states that maybe has a lot of state and local taxes, but if they're also a high earner and they make $500,000 or more a year, they're not going to get this additional higher cap. All right, and there is an inflation adjustment to this number over time as well. Okay, no tax on tips and overtime. Real quickly, I'm just going to hit this. There's a lot of ambiguity still around this. There are some above-the-line deductions, okay, for tip income and overtime pay. So what we mean by above the line is it's before the standard deduction and before the itemized deductions. It's before any of that. Okay? So tip income, you can deduct up to $25,000 for qualified tips. What's a qualified tip? All right, so single, that phases out above 150. So in other words, once your adjusted gross income is above 150, the ability to have tax-free tip income phases out, and it completely phases out at 400. And then married, filing jointly, there's the phase-outs. This is a temporary thing. So this is only effective as the bill is written from 2025 to 2028. The other question that has been floating around is, well, what's a tip? And or, look, can I just start considering some of my income as being tips? And so there's going to be some IRS rulings that come out about this, some additional regulations, et cetera, because this is very vague at the moment. The way the bill is actually written, my understanding is that it's that if you receive tip income in an industry where it is customarily regular to. So think your traditional, restaurants and valets and, things like that where you actually customarily make tips. And I have a feeling they're going to actually somewhat list what types of industries that will be. Overtime pay, we'll see how this gets implemented too, but those earning overtime pay can deduct up to $12,000. That's a single. For couples, filing jointly is $25,000. Again, this is temporary. It's only for 2025 to 2028. it's still unclear kind of what overtime is. And so, again, more clarification will come out eventually on this. All right, here's a couple other brief important changes. These, in my mind, are pretty important. So there is now a charitable contribution deduction for individuals, filers, that use the standard deduction. So remember, again, you can either keep all track of your itemized deductions, things like your state and local taxes, your mortgage interest, and charitable contributions you make. That all falls under this itemized deduction bucket. And for most people, they don't have enough of those to exceed what the standard deduction is. So they just take the standard deduction. So really, something like, we did the data on this at one point, almost like 90% of people that give to charities don't get any tax benefit from it because they don't itemize. Well, there's a change to that now. There's a charitable contribution deduction for individuals who use the standard deduction. Okay? So for single filers, that's up to 1,000 charitable deductions. And for married filers, that is an up to $2,000. Okay? There's no phase outs to this. This is permanent now. And so really what it means is, go back to my example earlier where we had the older couple that had all this, it was like $46,000 of standard deduction when you added it all up. They can also contribute up to $2,000 to charity and get an additional $2,000 deduction for that, even though they take the standard deduction. This is a pretty cool deal. And so this is something we're taking note of because, again, as we do a lot of charitable planning for a lot of you and our clients, we're going to be implementing and thinking through tax strategies that relate to this. There is another change for people who itemize. So your charitable contributions for people who itemize, there's now there's a floor that was instituted. In other words, you can't itemize any charitable contributions until it exceeds 0.5% of your adjusted gross income. So in other words, you can write off anything above that. Okay. Car interest deduction. This is another one that's gotten a little bit of fanfare in the media. Here's how it works, to our knowledge. This is, you can deduct up to $10,000 of interest per year on new car auto loans. This is not a used car, and it's not your existing loan that you got on the new car last year. Okay, this is new car purchases with new auto loans. You're able to deduct up to $10,000 of interest. The car has to be assembled in the U.S. Again, what does that mean? To be determined. That'll all come out. My guess is you're going to have, the dealerships are going to run with this, and they're going to, this car qualifies, has to be for personal use, so no business use, and again, new cars only. This is something that if you take the standard deduction, you can still use this as well. So this $10,000 deduction, potentially, on new car interest is on top of the standard deduction, but again, subject to phase-outs, okay, based on income. And this, too, is only temporary. All right, Trump accounts. This, I'm gonna cut to the chase on this one. We don't really know. This is what we understand about Trump accounts. What we don't know is how in the world is it actually going to work. But here's what it is. So the bill established what are being dubbed Trump accounts. They actually have a name. I think they're actually like MAGA accounts, but they came up with an acronym for MAGA, like money, access, something like that. Anyway, so Trump accounts are they're new, never been before, brand new account, tax-deferred savings vehicles, okay, in which the government, again, we don't know how this happens yet, funds a $1,000 government-provided funding into that account as a bonus, essentially, for babies born in 2025 to 2028. This is another temporary, right, 4-year deal. This may become permanent, who knows? All right, so if you had a baby born in 2025 or in any of these future years, there's going to be a $1,000 Trump account that's established. It kind of sounds like the government's going to establish it for you, but we don't know that. I don't know if there's something you got to do, all to be determined. Starting 1 year from the passage of the bill, which is next July 4th, it will allow for contributions of up to $5,000 per year that grow tax-free until the beneficiary withdraws money at 18 or older. So you can't touch it till you're 18 or older. The way the language is written is that it grows, without tax, and if it's taken out and used for qualified expenses, we don't really exactly know what that means yet either, then it's a capital gains tax treatment for the growth. If it's used for non-qualified expenses, then it's ordinary income plus a 10% penalty. Again, there's a lot of ambiguity around this. We'll figure it out eventually when more comes out. So don't worry about trying to get your Trump account open for your baby born this year yet. It'll get figured out. All right, we're closing in on an hour, so I'm going to try to run through the rest. There are some changes to 529 plans in this bill. The bottom line is that it makes them a little bit more accessible to, in terms of qualified higher education expenses. So instead of up to $10,000 being used for costs like K through 12, it's $20,000. You can use it now for standardized test fees, professional fee. I mean, in theory, our CPA or CFP renewal every year could theoretically be used from a 529 plan, things like that. Those changes go into effect next year. A couple other real quick things. Obviously, there's been a lot of news headlines around Medicaid changes. We're not going to go into that. The intent, as I understand it, was to try to limit some of the fraud in Medicaid to help pay for the bill. Again, that's been a political hot button that we're not going to dabble in. Lifetime estate exemption, gift exemption. So we've had some conversations with some of our clients around the estate tax exemption, and that was going to be reverting back to a much lower number. Now it's permanent. Okay, so the exemption in 2025 is $14 million per individual. So you can die $14 million per individual without being taxed before it passes to the next generation. This has some cost of living adjustments. Energy credits. So this is something that, at least to pay attention to. So this bill repeals EV credits for electric vehicles that are acquired after September 30th of 2025. So in other words, if you were on the fence and you were thinking, I think I'm going to go buy a Tesla or an EV that gets one of these credits, you better do it before September 30th to get the credit. And if that's the case, and there's a bunch of people that are thinking, you may want to do it sooner than later because inventory may be tough by that point. I don't know. There's also a repeal of certain energy-efficient home improvement credits. Okay, there was a credit for home improvements. There's some other clean energy credits. We don't dabble in a ton of that, but again, those are being repealed. So if you're adding solar panels to your house, or whatever it is, again, whatever qualifies for these credits, you probably should think about doing it sooner than later because they're going away. The child tax credit increases. The mortgage interest deduction, this remains at mortgages up to $750,000, makes it permanent. That was something else that was going to expire. And moving on. All right. So we're almost done. This is just a quick summary recap of what this bill, everything we discussed in the bill. Our intent is hopefully kind of create this and we can send it out, post it on our website, things like that, because it is a lot to try to gather. What's permanent and what's temporary? What's phase outs for what? Do I qualify for this or that? So this chart shows that. Again, we're gonna send this out at some point in the near future. I can't commit to when, and you'll see it because it's a great chart. All right. So where does that leave us? What's the tax planning? So what? So the first thing I'll say is that this bill does extend for the foreseeable future all the tax planning strategies that we've been doing. It crystallizes those and makes those permanent, which is great. Now we have clarity. Now we don't have to worry about, should we accelerate this because the rates might jump up? Right? We have clarity now. That's a huge, huge deal. Second thing, like I just said, if you're considering an electric vehicle or something like that, you should probably act soon, right? Now, if you weren't considering it, I don't know that anything in this bill should make you go out and do it, but if you were considering doing that, now's the time. Okay, consider the impact of all sources of income. We commonly, when we're doing tax planning, a lot of people forget about, well, they got money in a money market and it's earning, well, that interest is taxable, or that real estate investment they got it. So we really need to pay attention to, particularly with some of these phase outs. A lot of our clients are in that 65 to 70 age group that are going to qualify for these extra exemption amounts, the Social Security no tax. And so we need to pay attention and be mindful of, we want to use that if we can. So we need to know all sources of income and how they all interplay together. Starting in 2026, if you have not been keeping track of your charitable deductions because you don't itemize, starting next year, not this year, start keeping track of those, because you're going to get a benefit even if you take the standard deduction. The last question that's rumbling out there, absolutely, is will this add to the national debt? Again, that's a debate we're not going to get into right now. Obviously, when you're giving tax breaks to people, depending upon what your economic theory is, that will either be less revenue that the government takes, but it may spur growth. The argument that the Trump administration is that okay, this will be paid for through growth and we'll take in more tax revenue combined with tariff revenue, et cetera. Again, that's not a debate we're weighing in, but it's entirely possible that in the future, we could see other tax changes, because there are there's a real deal about we have a lot of national debt. The last thing I'll say before we wrap up here is, because some of these go in effect this year, we're already in July, and there's only 5-6 months left in the year. The IRS has a lot to do to implement this. Get the forms updated. And there's still a lot of ambiguity around a lot of this. Oh, and by the way, they have cut some of the size of the federal government, and so the IRS is probably not operating with as many people as they used to. And so I think there's a very real possibility that there could be some challenges as we get later in the year about still not knowing things, and still not having the forum for this. And, so that's something we're going to be very prudent about to understand, so we can keep an eye on, because if decisions we're going to make are going to be impacted by some of this, but we don't have the actual underlying data to know how it affects things, that's a real risk that we need to be mindful of. So, all right, that was a lot, I know. Hopefully that was, it probably wasn't very entertaining, but hopefully it was informative. Hopefully at least it gives you a little bit of semblance of an understanding about what this bill really does and some of its impacts. If you have questions, reach out to us. Again, we may not even know the answers yet, but we're going to continue to stay on top of this. We're going to continue to release more information and with an eye on how it impacts each of you. So thank you for your time. We really appreciate it, and have a great day.